Welcome, everyone. Very excited to host today's webinar, Becoming a Non-Resident, Understanding Your State of Residency and Sourcing of Income. And very excited that we are able to do this webinar jointly with the law firm of Greenberg, Traurig. It's a firm that we have worked with over the last couple of years on a number of residency issues. And it's just been a great collaboration with Ruben and Brad from Greenberg Traurig. There's a wealth of knowledge in the residency area on this panel. So I'm very excited to welcome everyone to today's webinar. California residency is a very hot topic in today's environment. There are, it's one of the top 5 audit issues that the Franchise Tax Board deals with. They're very contentious issues. There's a lot of nuances and concepts that are very important for people to understand when they're trying to make a decision as to whether or not to move their state of residency. And today's panel is really going to walk through a number of these very important concepts and some practical issues that come to light when an individual is trying to make a determination as to whether or not they should move outside of California. What are the implications? What do they need to do? And what is the audit risk of one moving their state of residency, particularly from a high taxing jurisdiction like California? So with that, I would like to introduce our panel. So my name is Akash Sehgal. I'm a tax partner at Greenhass & Jenks, and I also lead the tax practice. We have Frances Ellington, who is one of my colleagues at Greenhass & Jenks. She's a principal. She's our state and local tax leader, and she has a wealth of knowledge on California residency issues. And then I'm very excited to announce or have Brad Marsh, who's a shareholder at Greenberg Traurig. Brad co-leads the firm's San Francisco office, and he's got a significant amount of experience in a number of different state and local areas, including residency. And then Ruben Sislin, who is an associate at Greenberg Traurig based in Los Angeles. And Ruben also has a significant amount of experience in the state and local area and has worked with our firm as well as a number of taxpayers on a number of different state and local issues, including residency. So just to walk everyone through the format of today's webinar, we're going to have Frances speak for about 15 minutes or so on some state residency concepts. So she's going to walk us through a number of slides on very important residency concepts that we all should understand and know, particularly if we're looking to change our state of residency. And then what we thought we would do, which I think will be very beneficial to the attendees, is for us to have a panel discussion. So I'll pepper our panelists with a number of questions that a lot of our clients ask, that we ask as professionals, and really try to get their insight into residency, how it works, what are the audit risks, et cetera. And then we'll spend and that'll be about 30 minutes or so. And then we'll spend about 10 minutes on some Q&As with respect to the questions that the attendees have asked. So we certainly will not gloss over any questions that are asked by our attendees. Keep them coming, and we'll make sure we're able to answer as many questions as we can in the time that is allotted. So with that, I will turn it over to Frances to walk us through some residency concepts.
Thank you, Akash. I appreciate the introduction and excited to be here today to speak to everyone on the topic of state residency. Can we move to the next slide, please? So the topic for this webinar has come out of a few things. First, the remote work environment established in the COVID pandemic. Second, the high tax climate of California and other states. And third, our observation of clients, both individuals and businesses, and their desire to operate in favorable state tax jurisdictions. Some of the headlines that we have seen the past couple years relate to high-profile individuals and businesses leaving California for states like Texas, tax hikes for personal income tax in Arizona, Illinois, and other states, and government agencies such as the FTB trying to balance increased scrutiny on residency with state income tax proposals to increase rates or broaden the tax base. We look forward to sharing more insight with you throughout this webinar. Next slide. This slide is a snapshot of the highest marginal tax rates in the United States. As you can see, California and New York City residents have the highest rates. It's no surprise that the net migration out of cities like San Francisco and New York City is higher in 2020 than it has been in several years. States that we often see clients considering as alternatives to California include no individual income tax states, such as Florida, Nevada, and Texas. A couple of these states may tax things like dividends or other sources of income, but generally speaking, these states listed here don't have an income tax. We also find that individuals are more inclined to move states and establish a new domicile and resident state when they rely on investment income or are expecting a significant income event, such as the sale of a business. They generally do not have children or do not have significant ties to a specific location, and they have the flexibility and the income to be able to move. Next slide. The basic concept of residency in state taxation is that your resident state taxes 100% of your entire net income. So if you do pay state income taxes in other states, in California and most states, you will receive a credit, a tax credit, for any double tax income. For example, if you paid tax in North Carolina and the tax rate is lower than California, then you won't receive a full tax credit for the income tax in North Carolina. However, you will receive a partial credit based on the actual tax you paid in North Carolina. Non-residents in California and other states generally have to file a tax return when they have state source income, such as a K-1 from Arizona or wages reportable to another state for a temporary work assignment. Next slide. The cheat sheet on this slide shows various sources of income and how it is sourced in California. The summary is most helpful for non-residents. This is because moving outside of California does not mean that you have no California source income. A common misunderstanding of the benefit of moving to a no income tax state is that you may still have significant California or other state source income that is taxable to you as a non-resident. For example, installment sales and certain stock option events may still be subject to tax based on activity in California, such as work performed or when a transaction is deemed to occur in the state. Our point here is that it's important to understand your state source income as a non-resident or when you become a non-resident. Next slide. The California statute excerpt on the slide is deceivingly simple, and the residency determination in California is inherently complex and very facts and circumstantial. California has two presumptions of residency, which we will talk about in detail shortly. However, one issue we often see is that taxpayers focus on the number of days outside California and do not always focus on important aspects such as setting up their new domicile. Next slide. An individual can only have one domicile at a time. And if an individual has acquired a domicile in one place, he or she will retain that domicile until they acquire a domicile in another jurisdiction. So if an individual, for example, acquired a domicile in Illinois, comes to California for a vacation or on business or for some other reason, but intends to either return to Illinois or go somewhere else as soon as they're finished with their purpose in California, then they will retain that domicile in Illinois, and based on that activity would not acquire a domicile in California. Even though they might bring their family or have a home here or remain here for a period of considerable time. So it's important to understand that. Likewise, an individual who is domiciled in California and who leaves the state and retains the California domicile, as long as they have a definite intention of eventually returning to California, regardless of however long they're gone from the state or what the reasons for that may be. So it's important to understand that you have to consider your future plans and your future intent to return to California. If you're planning to move, for example, for 1 year or 2 years, the intent is that it will be for a period longer than, for example, 1 year, and that you will, at that time, do not intend to return to California. Next slide, please. Generally speaking, and per FTB guidance, there are two presumptions. So the first presumption is if you spend an aggregate of 6 months or less in California during the tax year and are domiciled in another state and have a permanent abode in the domiciled state and do not do anything in California other than what a tourist or visitor would normally do, then there is a presumption of non-residency in California. The second presumption is you're presumed a resident of California if you spend 9 months or more out of the tax year in the state. So both of these presumptions are rebuttable, but most analyses are subject to the facts and circumstances of each taxpayer. Next slide. The closest connection test is an analysis that the FTB goes through to help determine tax residency. The Office of Tax Appeals was established in 2018 and is a result of the restructuring of the tax administrative offices in California. This office is responsible for the court appeal decisions in residency cases. As the slide mentions, several of the closest connection factors were published in the Bragg decision in 2003. A caution on reviewing the factors for residency is the source income issue that we mentioned earlier. Even if your closest connections are outside the state, certain income may still be subject to California tax. Next slide. For the factors, it's important to understand that they are not all weighted equally. For example, physical presence is a primary factor. The location of your residential property and where your family resides are also significant factors. Ownership of cemetery lots or car registration alone may not impact your residency, but together with many of these factors and factors on the next slide, they may. Next slide. We often get questions about professional advisors and whether it's okay to keep California advisors. Generally, we recommend to keep advisors where it is appropriate, but also set up additional advisors in your new state for different reasons. This would be true for doctors, other professional and social memberships as well. The goal would be to shift enough activity to clearly show that your closest connections are in your new state. Next slide. In the analysis of your closest connections, You should consider the purpose and the length of your stay when determining either your current residency or your proposed new resident state. Generally, and per the California regulations, if an individual is simply passing through the state on their way to another state or country, or is here for a brief time or vacation to do business or fulfill a contract that will require their physical presence in California, then they're in the state for a temporary or transitory purpose, and therefore will not be a resident by virtue of just being in California for a short period of time. However, if an individual is in the state to improve their health due to an illness or is here for another reason for an indefinite period of time, for example, for business purposes, then that may be an issue, and they may not be in the state for a temporary or transitory purpose if it is indefinite in nature. And accordingly, this may be a situation where they may be considered a California resident, even if they have a domicile in another state or country. So these are definitely taxpayer-specific situations, and some individuals and businesses fall into a gray area where it relates to California residency. However, our job as tax advisors is to document and establish the most appropriate results for the tax filings. Next slide. So the final information that I would like to emphasize today is that other states have different rules than California. New York specifically has 2 separate residency tests, either of which will establish tax residency. The domicile test is more aligned to the factors considered in California, but the statutory test is heavily weighted on physical presence. For those individuals considering a move, you should consider not only where you spend your time now, but also where you plan to spend your time in the future. There are situations where you can be a dual resident based on inconsistent state rules. However, worst case scenario with California, you are allowed a state tax credit for other state taxes paid when you are a dual resident to prevent double taxation. So with that, hopefully you are able to gather some good takeaways from this presentation. And I will now turn it back over to Akash.
Thank you, Frances. I think that was a lot of great information on very specific concepts that it's very important for everyone to understand. And part of the reason for that is that as we go into the next section, which is the panel discussion, a lot of what Brad, Ruben, and Frances are going to be discussing are going to be items related to these concepts. So whether it's domicile, closest connection, number of days, these are topics that they're going to be discussing in their answers to the questions that I posed them. So on the front end, it was very important that we provide some information to the attendees on these specific concepts. So let's dive right into the questions for the panelists. I often find that that's one of the best ways to really get practical information on what professionals in this area are seeing with respect to California residency. And Brad, I'm going to start off with you first. So, Frances talked about a lot of different concepts, as I mentioned: domicile, closest connection, number of days. In your experience, not only as a practitioner, but on audits and appeals and stuff that you deal with the Franchise Tax Board, what would you consider to be the most important factors with respect to California residency?
Sure. So normally what we're trying to do when someone comes in the door and it says, I've had enough with California, I've had enough with these net worth taxes, I've had enough with the threats to increase the rate, or maybe, I think I can do well by moving out of state and receiving that income from the sale of my business, is we start by first talking about the move, the change in domicile. That's actually the number one piece, is setting the facts up to get their move to be official. After that, we move into these factors. And in my view, I've done hundreds of these audits now, and been in numerous hearings that we weren't able to otherwise resolve. Probably the most important factors are, one, where the taxpayer's real property is, in particular their principal residence. One of the favorite things of the FTB to do is to go ahead and say you maintain a house in California, therefore you are a resident. So that's one of the issues that we have to tackle and figure out how to handle for taxpayers. And it's different answers for different people. Another one is, and for some of you this may sound a little silly, but I see plenty of it, where the taxpayers, children, and spouse reside. I see plenty of spouses try to move out of state and leave their family in state. That doesn't work. I consider that to be a really crucial factor. Another big one is the amount of days. Now, I know Francis properly stated that they don't do a day count in California, not except for maybe with respect to presumptions, but there's no black and white test. So if you're 183 and a half days, you're a California resident. If you're 182, you're not. It's not like that here. However, they look very heavily at where you are all year long, and they do that by analyzing everything from credit card statements to sometimes, in extreme cases, the pings of your cell phone. And so that's another factor. I think there's probably maybe two more. The other ones are where the taxpayer obtains their professional services. Nothing tells the story, at least from the FTB's perspective, about where a person lives more than where they get their haircut, where their dog goes to the vet, and if they have a regular doctor that they're seeing, where that doctor is located. Those type of sort of everyday personalized services are key to determining where someone really lives. And then last, where the taxpayer is employed. That has consistently been a strong factor, and I think it takes on a unique aspect in the middle of COVID here, where we're trying to figure out where employees are located sometimes, including ourselves. I mean, I'm clearly not in my office today, and those type of things can impact residency quite a bit.
Thank you, Brad. I think that's a great oversight in terms of some very specific issues that the Franchise Tax Board looks at and that you deal with as a practitioner on a day-to-day basis. Next question, I'm going to ask Ruben this question. So Ruben, I'm a taxpayer. I move out of state. I said, you know what? I've had it. Too expensive in California. I moved to a low taxing jurisdiction like Arizona. I moved to Texas. I try to rent a condo in Las Vegas or Reno and do that thing. Should I be worried about an audit if I'm a taxpayer that moves out? What are some of the factors that would potentially trigger an audit? I know the Franchise Tax Board spends a lot of time and resources trying to identify taxpayers. What have you seen in your experience?
Absolutely, it's a great question, Akash. It's one that comes up often, especially for people planning a move out of state, right? And like you said, a lot of people might go to Nevada and rent an apartment there or a condo, maybe even make a purchase. When you've been filing as a California resident, say your whole life or for many years, and all of a sudden 1 year, you don't file a return at all, or you file as a non-resident, that's going to be a red flag. I mean, if your entire tax liability would have been, say, maybe a few $10,000, $20,000, FTB, then this is the Franchise Tax Board, they're probably not going to care, right? These audits take a lot of resources. They take years, and after the audit, it could be a very long process when taxpayers try to fight assessments. But if you're someone who, say, you had a $10 million gain on a stock sale, I mean, that's going to pique the state's interest, right? They are going to want to know, did you really become a non-resident? Is this income that we should have potentially taxed? You could have owed us $1 million+ plus penalties and interest, and we need to take a closer look at this. So that's, certainly a major factor, you stopping to file as a resident of the state. And also if you have a lot of income, I'd say those are some major factors. Also one thing, and we talked about this a little bit. So if you do move out of state, right, if you are a non-resident, you're only going to be taxed on income that's connected to the state, income that has a source in California. So you may not have such income, right? If you don't have any sort of, say, real property in the state, you don't have a gain on that, you're not collecting any rental income, you may not be in that category. However, you may still want to consider filing a tax return. And the reason for this is once you file a tax return, that triggers the statute of limitations for when the state could come back and conduct an audit and issue an assessment. They typically have 4 years to do that. So say you moved out this year, you file your return in 2022, the state can come back and take a look at that until 2026. But if you don't file a return, there is no statute of limitations. The period's open basically forever. So you don't want to sit there 20, 30 years from now and think about whether, hey, should I be worried that I might be on the hook for $1 million I failed to pay 20 years ago? I mean, chances are the state's not going to come back 20 years from now, but they can. So in order to avoid that possibility, you may want to consider filing a return. In terms of filing the actual return, when the time comes, if you have moved out of state, you're going to file as a non-resident. You're going to have to disclose your new state of residency, include details like how much time you spent in California. And one thing, we see this mistake made all the time, and it's a minor thing and it's easy to avoid. Don't put your old California address on the tax return, right? It just doesn't look good, and we see it done all the time. And if you're gonna go ahead and file a paper return, and that's not too common these days, don't drop it off, near your old Los Angeles home. Drop it off in your new state. If you're in Texas, you're in Dallas, drop it off in a mailbox in Dallas. Now, I'll get into just a little bit here about what to expect in terms of process. If you are selected for an audit, right, you're in that category where you are a high earner, and there's a lot of income you maybe should have reported according to the state. Just to give you an idea of what to expect there. Typically, there's an administrative process, and I like to think of it as 3 phases. Of course, the first one's the audit phase, right? And one thing that you should just sort of be aware of, this is generally not a fun, sort of easy process. It could be long and tedious. The state's going to ask you all kinds of questions. They're going to want to know a lot of details about your life during the years they're looking at. They're going to want your credit card statements for many years. They're going to ask about your properties, what you did on certain days, maybe why you pumped gas at a particular gas station, why you and your wife weren't together on her birthday, all kinds of things, details you may not want to share, right? And just being aware of this could be a deterrent for some people from even making the move. So that's just something to have in mind. This process alone usually takes at least several months. But we've been involved with cases where it could take several years, and that's really a function of the auditor's workload, what sort of information they're asking for, how deep they're digging, and how cooperative the taxpayer is. Are they providing everything that's being asked for? Are they being evasive? So it really depends on sort of both parties. Akash, if we're okay on time, I'll go into a couple more details here.
Sure, please. Go ahead.
Process. So in terms of, say you do go through an audit, right? At the end, you're going to get one of 2 things. You're either going to get something called a no change letter, where the state's going to say, hey, we agree with you, we put you through this process, but you are a non-resident, and we're basically done, and you can go on about your day. The other possibility is you're going to get what is known as an assessment. This is basically the state saying, we disagree, you are not a non-resident, and you have to pay tax on all of this income that you earn. And the decision could be for just one of the years they looked at, or it could be for multiple years. It could be for all of them. If you're in that category, you're probably not going to agree, right? And it doesn't mean you have to necessarily pay the tax. You could continue fighting, for your position that you were a non-resident. And what you would do is file what is known as a protest. And this is, another administrative process. There's briefing involved. You would produce additional evidence, or maybe the evidence you've already produced. And this, again, will take typically another at least few months. We've seen it generally take longer, at least 1.5 years, but sometimes even longer. Once you get to that process, again, if you're unsatisfied with the results, you're still not done. You can always appeal your case to the Office of Tax Appeals. Francis talked about this. And this is really, you can think of it as California's sort of tax court. They hear tax cases generally, not just residency cases. And this is sort of what I consider your first sort of fair shake at this, right? You have a panel of 3 administrative law judges. They're independent from the agency that issued the assessment. And again, this is more of a formal process, I would say, more like a court, but not quite as formal. And again, this process, like the ones prior to this, will take at least 1.5 years, and we've seen them take a lot longer. I'll stop there. There's a lot more to say on this topic, but I'm sure others have comments as well.
Okay, let's thank you, Ruben. I think getting some background on the audit appeals process is very helpful for a lot of the attendees to understand, because a lot of them have not necessarily gotten to that point or haven't left residency. So understanding how long of a process this could be if they are triggered for an audit, I think is always a factor in someone making a decision as to whether to move or not. Brad, one of the things that you mentioned, which is a very common question that we have received from a lot of our clients, is the idea of timing of the move. So I'm a taxpayer. I own an interest in a C Corp. I own stock in a C Corp. I'm looking to sell my interest in the C Corp in a certain period of time. It's going to result in a huge liquidity event for me. I'm a California resident. Can I move a week before the liquidity event? Should I move a year before? Obviously, there's no concrete answer for that, but the longer the better is usually the answer. What have you seen or recommended to clients that come to you and say, look, I'm going to come into a lot of cash. I want to potentially minimize the California tax impact. When should I move my state of residency?
That's a great question. It's one of the most frequent ones. I've seen all different types of personalities and strategies here. I'm generally going to say what you said, Akash. I'm going to say, if you know you're coming into it now and you have 6 months until we think it's going to close, move tomorrow. Move as quickly as possible. But I have plenty of people who don't heed that advice, or they come to me after they didn't heed that advice and they try to move, like the day before closing on a big transaction like that. In fact, I have someone that did that just in December on a closing. And, I have to sit down and explain to them that's risky. And the reason why it's risky is because, yes, there are some things you can do that are really obvious to change your domicile, to put yourself in another state. And normally that's what we first go through when we're advising someone on moving out. We'll sit and talk about when can they move and how are we going to do it. And there's just a few fundamental features that we're putting up front there. Number one, you have to actually have a place to live. That's a long-term place where you're going. Ideally, someone's buying a house. They're moving, right? So that takes a little while. You've got to get your house. You've got to get a spot. You've also got to actually move your stuff. And in particular, the way these laws play out, you're trying to move the stuff that's most important to you. So if you're a golfer, you're moving your golf clubs. If you collect teacups on the wall, you're moving those precious teacups, your family heirlooms, your clothing, your important personal matters. And then we always like to try to advise what I kind of consider to be, especially if you're a fan of Office Space, this old movie, we like to advise some flair around the move. What I'm talking about is, and it was easier pre-COVID, but we're talking about announcing your move to your friends and family and announcing it publicly. Nothing is more powerful to an auditor than a going away party with photos, or the fact that all of your LinkedIn account and your Facebook and everything else has these posts saying how much you're going to miss and love these people, and everyone's saying their goodbyes. And then, of course, there's completing the move, which is once you get there, we have all these brag factors that we talked about earlier, and you've got to punch those out, sort of one by one. And that doesn't always happen in one day, right? I mean, you don't find a new dentist on day one. You don't file your tax returns on day one. Some of these factors take time to happen. You don't find your hair salon on day one. And so for all those reasons, a lot of these residency cases really just end up boiling down to not whether someone moved, because after a period of years and by the time the audit comes, it's pretty clear they moved, hopefully. If it's not, then there's been a big failure in this process. But it's really, when did they move? And so, we always advise on the date, the position to take on that date for our clients. And I know that the returns get prepared with that date on it. And then the audit turns into, well, we don't think, this is the FTB talking, we don't think that you moved on that day. We think you moved, and it's always like a little bit after your income realization date. That's the day we're willing to concede. And so, of course, the earlier you can start, there is a reason for that. It's not just being a worrywart of a tax attorney. It's because you can get all those factors in line, and they will have little, if nothing, to be able to try to adjust your move date. So yeah, but can you, if you're the right person, move in a day? Yes. I have moved people on like a day or 2 days notice, and they've survived audit. Do I recommend that? No, not even a little.
Thank you, Brad. I think I think one of the key points that you brought up is on the timing is it's very important for taxpayers to speak with their attorneys or accountants as early as possible when they are looking at some liquidity event and potentially moving out of the state, to really plan for that and do that accordingly. I always tell people that, or a lot of my clients, that if you want to move out of California, you really need to do it. You need to be 100% about it and make the move, do everything that's required, listen to your advisors about the experience they have in this area, and do it as early as possible. And really think about what's going to happen after the liquidity event. Are you going to come back in 6 months? Are you going to come back in a year? Are you going to stay in your new city or new location for a longer period of time? These are all factors that need to be considered. So the next question I have is related to sourcing, and I'll ask anyone this on the panel. And as a matter of fact, a lot of the questions from the attendees so far have been around sourcing of income, right? So I'm a California resident, I move outside of the state. I may have income from California sources, whether it's rental income. I may sell a piece of property in California, that's California source. I may have W-2 wages from a company that's based in California, but I live in another state and I physically perform my services in a state. I may be a sole practitioner that has a business that operates in California and outside of California. And I know there's a line of unitary cases that have come out. The question I have for the panel is, what do taxpayers need to look at in terms of sourcing? What potentially could be taxed in California that we often think should not be taxed in California because we've made that move outside of the state?
Well, I think there's actually two issues here. Issue one is really more of a COVID issue and sort of present day society piece, and that is there are plenty of people working outside of the state. But does that mean that they're no longer California residents because as a part of COVID, they moved to Colorado and they're now working out of there? In my head, that's an open question. We, have to talk to each individual person, find out what their intent is, if they are determined to move or not. And ultimately, if I'm saying it as succinctly as possible, whether they moved out of California for temporary and transitory purposes, i.e. until COVID's over. And we even have some people at our firm that have done that. The second part, I think, is what you're really asking, which is about this whole sourcing piece. And Francis put up earlier on a slide sort of the quick study of what would be considered California source income or not. And Ruben also commented just a little bit ago about the fact that it sometimes is okay and good to have some California source income. The things that surprise people the most, I think, and it's really sort of a developing area of law. I'd be interested to hear what Ruben and Francis think about it. But is that the Franchise Tax Board has started taking even more aggressive positions over what constitutes California source income, and they're doing that under what was traditionally you would think of as just business tax regulations. So for example, there was a case that came out, it was, I can't tell you for sure, but it was in the last year or two, called Bindley. And you had some person in Arizona whose job was simply to write screenplays. And they were contracted to do that with a California company. And, they, of course, like a normal person, reported their wages in the state where they were doing it, which in this instance was Arizona. California came in and audited and came up with this new theory. And it was approved by the California taxing body. And the theory is this person that was writing these scripts from their home in Arizona was engaged in a sole proprietorship. And so they had a business entity, which was this sole proprietorship. And when we combine that business entity with this other business entity that they're working for in California, then all of a sudden, poof, magically, because the benefit is received in California under a bunch of complicated regulations I won't go through now, this is now California sourced income, and this person is now taxable in California. We're seeing those kind of surprises come for taxpayers. The FTB is currently sort of figuring out how they want that theory that they've now got approved by the Office of Tax Appeals to apply under different fact sets. So that's, I think, where the gotcha moment is for most people these days.
And I know Ruben can probably expand a little bit more on the related controversy, but I want to reiterate a point that Brad made, and that is the classification of whether you're an employee or a contractor. For example, you receive a 1099 is very important, because traditionally and under California rules, your wages, for example, on a W-2 would be sourced to where the work is performed. So whether that's Arizona or California, it's definitely sourced to Arizona if the work is performed in Arizona. And if you're a California resident, that's another issue because it may also be subject to tax there. But if you're a 1099, then there are another complex set of rules, which Brad alluded to. So the classification issue is very important to understand.
Yeah, so, I'll just add to that topic along the lines of what Brad and Francis have already said. But yeah, this is, sort of the new approach the state's taken, and unfortunately, it's something that has been approved by the Office of Tax Appeals, where they're sort of looking for new ways to bring in the income that would escape the state, right? In some of these cases, and there's been, a line of them at this point, it's not even people who moved out of state, right? It's people who have always been in a different state. So, the state's always looking for more revenue. This is certainly one way of doing it. Now that we're aware that these cases are out there, right, in terms of 1099 income, this is something, if somebody's thinking about moving out of state and that's the sort of income they have, this is a new risk they need to consider. And, the state's not necessarily right, but it's something you're going to have to put up a fight for. So it's something to think about. One other thing I just want to add here is, oftentimes, we'll meet with people who are thinking about moving out of state. And the question is typically, what do I need to do to get out, right? How much time do I need to spend in the new state? How often can I come back? What do I need to do? The things we've already talked about. But a more sort of preliminary question they don't, think about or should be asking is, hey, if I go through the trouble and do all these things, what impact is this going to have on my taxes, right? So if you're in the 1099 category, right, or you're somebody who's getting all your income from rental properties in California, the move's probably not going to help you at all. So maybe, they need to think about that question first, especially if the move is really being done as a way to sort of save on taxes. You need to think about that question and then get into the question about what are all these things I need to do to make sure I'm considered a non-resident for tax purposes.
Yeah, thank you, everyone. And that actually, Ruben, that actually answers a question one of the attendees had is, if I move outside of the state, but all my income is California source, is there really any tax benefit of moving? And I think the answer is generally probably not much benefit, because you're going to be paying California tax on all of that income. Now, there's other factors to consider, but in general, if all of your income is California source, and we've seen that, we've seen taxpayers move and don't realize that all their income is still California source. The other questions, and this ties to some of the questions that the attendees answered, which I think you guys touched on, but I'll just kind of add to it. I think it'll cover several of the questions by the attendees, is the W-2 wages. So if you work for, so typically the way it works with W-2 wages is if you work for a company that's based in California and you live in Nevada or you live in Arizona or another state, and you physically perform your work in that other jurisdiction, then that should not be California source income as long as it's W-2 wages, right? I think now what we often see are situations where that individual travels to California and physically performs work, like they'll go to the home office, they'll be there for a couple of weeks, they'll be there for a month, and then you get into non-resident withholding and some other issues that apply there. But I think with respect to W-2 wages, it's a little bit more straightforward than I think what Francis and Brad mentioned on the 1099 side, which is that the state's really looking at trying to attribute some of that 1099 income to where the company that you're performing that service for is benefiting from that service, which again gets into some business sourcing rules on the apportionment side, which is something we can discuss at a later point in time. So I think that was one of the questions, and then maybe to jump into some of the attendees' questions. Just give me one sec here. So.
Akash, I can comment real quickly on what you just said as well. So another thing I want to add, for W-2 wages, it's also important that your company knows where you're physically working. And if they're only set up, for example, for California payroll withholding, the only thing that you don't want is that they just automatically issue a W-2 that says California wages, because that will create more questions and issues when you ultimately file your tax return. So it's important to make sure that not only, do you know what the rules are, but also that your employer is, up to speed and is able to help you in that process.
Yeah, that's a great point, Francis, because we're seeing that, and I'm sure a lot of companies are seeing that. Brad, you mentioned you had several employees at your firm that moved, and what often happens is if you have employees that change their state of residency during the year, they may go from being a California resident to resident in another state, and they're not going to want you to withhold California income taxes from their payroll. They're going to want you to withhold payroll taxes in their new home state. So the company needs to get registered for payroll tax in that other state. That may create an income tax filing obligation depending on what that individual is doing. So there's a lot of factors. So the key point is if you are looking to move outside the state, it's very important to have that conversation with the company that you work for. One of the other questions that came up from the attendees was K-1 income. So I'm a partner in a partnership, or I'm a shareholder in an S corporation. I live in Texas, but the partnership operates in several different states, including California. I get a K-1, it shows California source income. Do I need to pay tax on that in California? Francis, I'll ask you that question.
Yes, the short answer is, of course, with your California source income, you do have to pay tax on that. The only caveat that I would say is just make sure you check with your accountant and make sure that source income is reported properly. Sometimes, if 100% of that income is reported as California, that may be the case, but we do want to make sure that you're, for non-resident, that you do have the California source amount reported on your K-1. Rather than pulling the gross amount for federal tax purposes from that K-1.
Yeah, and one of the things we often see with K-1s are things like guaranteed payments. So in the partnership context, guaranteed payments are often paid to partners for the services that they perform. And under the current California law, guaranteed payments are actually sourced in the same manner as flow-through income. So you actually are required to source guaranteed payments based on the apportionment factor of the underlying partnership that's paying the guaranteed payments. At one time, it used to be kind of this 60-40 split where 40% was sourced based on where the services were physically performed and 60% was based on this apportionment formula. But in today's environment, so that actually surprises a lot of our clients who live outside of the state, but the company that they work for or are a partner in is heavy in California. Often a lot of their guaranteed payments may be California source as One of the questions, and I'll ask Ruben and Brad this because I think it's from an attorney, is I move outside of the state. I live in Florida, but I maintain a California law license. I have a professional license in California. I work on clients that are based in California, but I live in Florida. Am I required to pay California tax on the income I earn from those clients?
What a fun question. And part of the reason for that is that you know, I'm at a pretty large firm, and we have New York attorneys that do that exact strategy. They move to Florida at some point in their career because we also have Florida offices, and they count days because New York has more of a day count. You know, to precisely answer the question though, when we do that, if you want to do it right, and you want to be able to really, you know, sort of withstand an audit on that, you want to get licensed in Florida as well. Because you're supposed to, under the ethical rules of the bar, etc., only practice where you're licensed. And that includes, again, technically doing work in Florida, even if you're only doing California type work. And so what we recommend, what we joke around when they pull out their little timer app, when I meet them in Florida for a meeting, pre-COVID that is you know, is exactly that. So if you are able to get licensed in Florida and go ahead and move and run your practice from there, then you should be able to source quite a bit of the income there. Yep.
Thank you, Brad. There's a couple of questions on things like government pensions, pensions in general. And I believe the rule in California, you guys can correct me if I'm wrong, is I think there was a federal mandate that states could not tax a non-resident's pension, obviously being different than deferred comp, right? So deferred comp is a separate thing than a typical pension that they may receive, like a 401k or something of that nature. I believe that to be the case in California, that California generally cannot tax a non-resident's pension as long as it's not set up as like a deferred comp type arrangement.
That's my understanding as well. I think it's been the case since the mid-90s in California, and there's definitely some publications out there. What's always worth doing is not just relying on that being the general rule, but actually digging in and checking, because there's lots of different types of pensions and deferred comp type arrangements. And so, you know, general rule, not a problem, but dig in a little bit on the specific plan that you've got and make sure. I think that's publication 1005 at the FTB. I just dealt with this last week. Deals with the pension. So maybe start there or start with your advisor.
You know, I'll just add to that. I mean, you know, you have people who maybe have stock options or things of that sort that were issued when they were a California resident. These aren't things that get, and you know, you don't end up exercising them until sometime later once you moved out. It could be several years later. You know, this kind of ties back to where the wages were earned, right? So if you performed your services in California for your employer when those stock options were earned, you know, at least some of that income is going to get tied back to that time, even though you're not going to get paid later. I think sort of the official position on this might be that all of it should get sourced to California, and you know, I'm not sure if there's much support for that, but there's ways of you know, kind of looking at that, seeing what portion of it was earned while in California, what portion of it was earned when you left the state, and not having to, you know, source all of it to the state of California.
Yeah, unfortunately, devil's in the details on that question.
Absolutely. So it looks like we just have a couple more minutes, and there are still several questions from the attendees. Some of them are fairly detailed. So, you know, obviously after this, we'll try to get back to as many people we can on their very specific questions. But I do have a couple of questions that I think tie into that for the group. So one of the questions being number of days. Right. So what is the maximum number of days I can spend in California and can still be a non-resident? And I think, Brad, this goes to the presumption, and Francis, what you talked about, which is the presumption in California that if you're in the state for longer than 183 days, you're a California resident. That's a rebuttable presumption. It can be rebutted by the taxpayer if other factors show that they're a non-resident. But let's talk a little bit about the number of days and what you guys typically see there.
I guess I'm happy to start. So the presumption is if you're here for more than 9 months, you're a resident. But those like you said, it's rebuttable. It's not a bright line, and there are no bright lines here. We see interesting circumstances. For example, if someone is a resident of Texas and they come to work at a California company for 18 months on an 18-month contract, are they a resident of California? I don't know. I don't think so. And I think there's plenty of rulings out there that, you know, assuming the other facts fell in line, would decide with me. So even if they were here for 18 months straight, they're really not a resident because they're here. Why? They're here for temporary and transitory purposes. They're not actually intending to move here. They're living in some furnished apartment and just working for 18 months. So circumstances arise where the counts don't work at all. Now, but you're right. One of the most common questions is, all right, I moved out. And so we're going to assume that someone moved out, they changed their domicile, they've got their new house and their new dentist, but they still want to come back to California. How many days can they come back into California? That's very common. And, you know, my answer is not based on a statute. My answer is just based on audit experience and what they're looking at. And it's sort of a two-part answer. Number one, you do not want to be in California more than any other state, especially the state you're claiming as your home state. So let's say you're a traveler and you travel all around. I might tell you shouldn't be in California more than 3 months. If you're only home in your home state for 3 months. So you need that. And then of course, I always try to keep everybody definitely under 6 months. I really advise planning, if you're a person planning your trips to California, plan for 4 months or less, 3 months or less, ideally. Because why? Because things will come up and maybe you'll need to be here longer, and then you find yourself in, you know, sort of this gray danger zone.
Yeah. And just to add to that, I think an important aspect if you're considering moving outside California is really tracking your days. So this means, you know, every week or every month that you have an accurate record of how many days or even partial days that you spent in California, as well as the other places that you're visiting, because that evidence will be very important should you ever have to deal with an audit from the FTB. And then you don't have to worry about going back and trying to piece together information to substantiate where you were. One interesting, actually it's an app that has come up with a couple of clients of ours. It's called Tax Bird. It's a way to essentially track your location on your phone if you don't have, you know, access to a spreadsheet every day and things like that. So there are definitely alternatives out there to help you track your location.
Thank you, Francis. Oh, go ahead, Ruben.
I'll just add something quick. So, of course, the number of days is going to be important, but that's just sort of one aspect of it, right? A big part of it is also, what are you doing when you're in California? What is it that you're doing when you're in your new state of residence or the other states or countries you may be in? So I'll just leave you with that. I know we're running short on time.
No problem. So I actually have one final question, and if somebody can answer this in let's call it 20 seconds or less. When should I retain a CPA attorney to help with my move out of the state? What does that timing look like?
As soon as possible. And the truth is that this is one of those situations where an initial upfront planning saves a lot of headache later. The consultation or whatever it is, and I don't know, Akash, how long it would take you to go through that, or Francis with a client, but most of the people I meet with, we can get to an understanding about how this is going to work within a couple of hours, hour and a half, 2 hours. We go through the factors, I learn about them, their life, etc. And then we come up with a plan, and maybe there's a little bit of questions about the plan, but usually that's it. That's the upfront investment. And what that saves you is it saves you from a huge headache of an audit. Because why? Because you have a checklist now, and you have talked about how you're going to deal with the toughest issues in your move.
All right. Thank you, everyone. Thank you, Francis. Thank you, Brad. Thank you, Ruben. And thank you for all the attendees for coming. I think there's some questions on, will we be sharing the recording? I believe the answer is yes. We'll be sharing the slides. But as you can see, and based on the questions, there are a lot of very personal type questions, and there's a lot of nuances with each individual's personal tax and personal professional situation. And so there's a lot of different things that are very specific to each taxpayer. It's hard to make a lot of generalizations that apply to every single person. So again, consult with your attorney, consult with your CPA firm, your accountant, get the advice that you need on the front end, because it's obviously a very important issue. So I want to thank all of the attendees, thank all of the panelists, and it was a great topic. Thank you very much.